got a pretty robust agenda, so I want to make sure we have as much time to get through the material and answer any questions that you might have over the course of the hour that we have blocked today. Thank you for attending. My name is Eric Daly. I'm the managing principal of the Multnomah Group, and today's topic, why your retirement plan doesn't work, and a couple of housekeeping items before I get started. One of which you'll notice in the Zoom application that there's the capability to ask questions. I encourage you to do that over the course of today's presentation. As you have issues that pop up, I'm happy to try and answer those questions over the course of my prepared remarks and further follow up on any questions that we may not have a chance to get to. Second, we've muted the lines for call quality, so hopefully that will help improve everyone's experience. Third, we will be sending a copy of this deck to those who attend today. So, feel free to take notes, but know that the prepared remarks and materials will come your way as well. And then last but not least, we're recording today's presentation. So if there's something that either you want to go back to or someone else in your organization may be interested in, please know that that will be available as well. As we get into it, why your retirement plan doesn't work, it's a very robust presentation today. The topic of behavioral finance is one that I'm highly interested in, and our organization pays a lot of attention to. And really, this is an attempt to take a look at some of the issues that prevent retirement plans from being successful. I do think it's important to point out that this is not like many of our presentations, this is your legal requirements type presentation. This is, once you've met your legal requirements, what can you do to make your plan more effective and more successful in helping progress participants in a defined contribution setting toward an on-time retirement. We're really going to touch on 4 topics. One is just an explanation of these behavioral biases and ultimately how they impact retirement savers. The second, we're going to really get into the 4 types of issues that pop up in determining whether participants can retire on time and in a way that they may want to. We're going to get into some very simple cures. The good news about behavioral finance is that while the issues and how the mind treats these decisions is complex, the way that we can fix and repair them is not. And then last, this notion of inverting your defined contribution plan. How can we make defined contribution plans more effective and have greater outcomes and using some of the fundamentals that we may have learned in managing defined benefit plans to help make those decisions. Let's get into behavioral biases. I think the important thing to point out is that while we present it frequently as such, defined contribution plans and how to manage your own 401k, 403b, or 457 is not as simple as a math problem. I think we communicate it that way to participants. You put in X, you receive Y return, you retire at age Z, and ultimately you will have a successful retirement. I think ultimately the study of behavioral finance is one where we look at how participants make those decisions, and unfortunately some of the ways that we may be wired to make decisions that are not in our rational best interest if we were looking at it purely from a mathematical equation perspective. I think in first looking at a defined contribution plan, I think we have to kind of acknowledge that there are really, from our perspective, 4 things that impact the success of your defined contribution arrangement, even at an individual participant level. The first is, how much did you put in? The second is, how well did you do investing those dollars over the course of your accumulation period? The third is, did you utilize any tools on the back end to try and preserve lifetime income? And the fourth, ultimately, and one that you have probably less control over, is how long is that retirement period, right? If you retire at 88 and die at 89, you don't need to accumulate much to make that work out. If conversely you retire at 55 and live to 102, you're going to have a very different mathematical equation. I think one of the primary challenges that we all have, and it's not unique to retirement plans or finance, but it's the notion of a confirmation bias. And that notion is that we are always seeking out information sources and people who agree with our pre-held positions. So we find those experts, we consume their information, and it reinforces what we already believe based on past experience. And of course, the challenge of that is ultimately it gets harder and harder as we age to get people to accept new information that might challenge some of the decisions they've made up to this point in time. So let's start with the first of those four equations, right, which is how much do I contribute to a retirement plan? And I think in an effort to overcome behavioral finance, financial services companies have gone to a model of saying everybody needs to save a ton of money. Because if we get people convinced that they need to save a ton of money, we don't need to really get into the nuances of how much a ton is. Is a ton 10% or 12% or 15% or even 20%? If we can get people to as high as they're comfortable going, maybe that will help them overcome some of the complexity about retirement savings rates. Realistically, there is some really good economic accounting data about how much a participant needs to save over a working career to try and accumulate a good retirement. Clearly, no defined contribution setting, because of how the plans are orchestrated, provides a guarantee of retirement income, because ultimately it's also dependent on investment returns and the length of the retirement period. But what is true is the higher your income level, the more you're going to have to save. For lower income workers, ultimately much higher percentage of their pre-retirement income will be replaced by Social Security. So having some acknowledgement of the complexity of this particular topic, then the challenge becomes how do we get participants to accept that level of complexity and acknowledge how that may interact with their own financial situation. Because what we do suffer from in every defined contribution plan is what's called status quo bias. We frequently refer to it as inertia. We see it certainly in savings rates. We see it in enrollment rates. We see it in investment allocation and rebalancing decisions. Humans dislike change. They don't like when we change their health benefits, their title, where they park, and they certainly aren't interested in making changes to things that they perceive as being complex or beyond their ability to manage effectively. And we really see this as it relates to savings rates for participants. If we take a look at really the three primary types of defined contribution plans, plans where participants have to opt in, plans where participants are default enrolled or auto enrolled into a defined contribution plan, but then are not changed after that. And then the third, plans where participants are default enrolled or auto enrolled into a plan and then periodically have their deferral rate escalated until they elect to either cap it or change their deferral rate. There is a tremendous difference ultimately in the level of savings that those types of plans ultimately achieve. And it really comes down to the status quo bias, right? If our status quo is we default enroll you and we automatically escalate you up to a certain percentage, that requires no action. The benefits of inertia and the status quo are accepted, despite the fact that things are changing. The fact that the participant is not the one required to make those changes is pretty impactful. So if you look at plans that have a savings rate in excess of 15%, 24% of those are plans that ultimately utilize auto enrollment with auto escalation. When we look at the low savings rates, almost exclusively that's dominated by plans where participants are forced to elect an enrollment or deferral percentage themselves and monitor and change those things prospectively. If we look at it on a more targeted basis, the two primary populations that most defined contribution plans struggle with are their lowest paid employees and their youngest employees. And we'll talk about some of the other behavioral finance biases that have an implication on that. But if we look just at the most simple, do we have automatic enrollment or do we not? For employees under 25 without automatic enrollment, average savings rate of 3.9%. With automatic enrollment, a full 1.5% higher. If we look at participants earning less than $30,000, average savings rate if they have to opt in, 4%. Average savings rate if there's an automatic enrollment functionality or default enrollment, nearly 50% higher at 6%. These are meaningful differences. And if you go back to how much a low-income earner would need to ultimately save, this has a tremendous impact on their retirement security if we can have that level of impact by modifying how the plan is structured. Similarly, for our youngest employees who have the longest time horizon, a 1.3% difference in their deferral rate at those early ages is going to have a tremendous impact by the time they've been invested in a defined contribution plan for 30 or 40 years. The status quo bias also kind of falls back to committees and how they structure plans. If we take a look at automatic enrollment plan rates, and I'm looking at larger plans here, plans with more than $200 million from the DCCI study, we've also seen a tremendous amount of change. Part of the status quo bias in automatic enrollment was initially when automatic enrollment became popular, what we saw was a 3% automatic enrollment rate by an overwhelming majority of plan sponsors in the marketplace. And really the 3% was something that had been framed by the Internal Revenue Service when they first talked about automatic enrollment in defined contribution setting. The example they used in their published materials was a 3% automatic enrollment rate. Well, it wasn't guidance, it was merely an example, but essentially plan sponsors used it as guidance and pegged to this 3% level. But what we've seen now is a change and a move to higher automatic enrollment rates. So what has worked clearly at a 3% level is only going to be more effective at a 4, a 5, and a 6% automatic enrollment rate. You can see the tremendous change, even in a 6-year period of time, from 3% defaults to now 6% defaults being not entirely uncommon at all among retirement plan sponsors. We add to that data from the PSCA that indicates that participants don't have a materially different impact on whether they opt out of a default enrollment setting, whether we set the automatic enrollment rate at 3% or 6%. There was not a statistically significant difference in the percentage of employees that elected to not participate rather than be auto-enrolled into the plan. But clearly, at a 6% savings rate, those participants would benefit dramatically from the change in how the plan is structured. So solving for savings rates, I think, is one that's been talked about tremendously with a great deal of frequency. And I think the notions of automatic enrollment, automatic re-enrollment, auto-escalation are notions and topics that have been discussed with some frequency. I think the one that committees spend a fair amount of time worrying about for understandable reasons is this notion of how in a defined contribution, especially in a participant-directed defined contribution setting, do we get participants to achieve adequate investment returns? That being the second component of that 4-factor model as to how participants are impacted in a defined contribution setting. And for those of you who are statisticians, you see the bell curve all the time, right? Which is most of the population is average. Some people are exceptional. Some people are below average. Think of this in the context, for those of you who are in human resource, in a periodic employee reviews, right? We should have a big chunk of folks who are performing at expected levels, a small chunk that are in the left-hand side of the distribution that are underperforming, a small chunk on the right-hand side that are overperforming. But generally, we fall within this bell curve shape. And if that were the case, you would expect that, hey, on the far left-hand side, as it relates to retirement, we've got people who don't understand what a retirement plan is, hopefully not a large number. In the middle, we've got most of the people who at least understand that stocks are more risky than bonds. And on the far right-hand side, we've got folks who are pontificating about how the trade war is going to impact currency rates in their portfolio. While most distribution curves set up in this way, I would argue that after 20 years of consulting to retirement plans and conducting employee education, that really what we have is an inverted normal distribution curve. And it's related to confidence, really not competence. On one side, we've got a huge portion of our population that is, I'm freaking out. I either don't know retirement, don't have time to deal with my retirement. I've got other priorities. I do not fundamentally want to have an active role in managing my own retirement. And on the other side, we've got a group of folks who believe fundamentally, either correctly or not, that they know a tremendous amount about investments, and they have very firm positions that they want to espouse with the retirement plan committee to try and get them to take action that's more consistent with their belief set. So if we accept the phenomena that we do have these two types of investors and probably a much smaller group that are somewhere in the middle, what is astonishing and continually astonishing is how poorly individual investors do relative to the marketplace as a whole. This is a study that you may have seen other places. It's the Dalbar study, where annually they take a look at the impact of investor behavior on achieved levels of investment return versus the performance of the markets as a whole. So for instance, over the 30-year period ended December 31st, 2016, the average equity investor achieved a 4% net of fee return. Over that same period of time, the S&P has generated a return of over 10% annually. The average fixed income investor has achieved a return that's just barely over 0.5%. Over that same period of time, the Barclays Aggregate Bond Index is up over 6%. Inflation at about 2.5%. Ultimately, what this is saying is that equity investors themselves have barely outpaced inflation. Fixed income investors have dramatically underperformed inflation. But perhaps more startling is just the disparity between an equity investor and the index, the fixed income investor and the index. So for equity, on the equity side, you're looking at a difference of 6%. On the fixed income side, you're looking at a difference of 5% annually. And while some of that is fees, I haven't seen many investment products that carry 5 and 6% annual fees. The remainder of it ultimately are these behavioral finance issues that impact why participants achieve such a diminished return relative to returns that are generally available in the marketplace. So let's take those two pockets of investors and break them out again. On one side, we have these low confidence investors. They're subject to a number of risks that I'm going to highlight for you: bandwagon effect, familiarity bias, regret avoidance, and negativity bias. For our high confidence investors, not surprisingly, one of the biases they struggle with is overconfidence, right? Hindsight bias, looking back and thinking that backwards somehow has an impact on what's going to happen in the future. Familiarity bias is one that still high confidence investors struggle from, and gambler's fallacy, ultimately not understanding risks and rewards and the statistical ramifications of those two things adequately. So let me start with the low confidence investors first. I would argue and do argue for committees and with committees frequently that as it pertains to our low confidence investors, our primary objective is to get them invested in a diversified portfolio that they can maintain easily and cost effectively through a number of different market cycles. If we get them in the plan, we know that market cycles will occur. We know that there's going to be periods of significant negative return. How do we develop solutions for those low confidence investors that allow them to maintain that approach without falling trapped to some of the behavioral finance biases that I'm going to talk about? One of the big ones is bandwagon effect, and I'm going to talk a little bit about both the risks of bandwagon effect and then how you may want to try and mitigate or manage that risk as it pertains to your participant population. But the bandwagon effect is very simply the notion that participants or individuals tend to follow the behavior of their peers or the masses when making decisions that they may not have a high level of confidence in. For instance, adopting fashion and clothing styles. So I am not a fashion-forward person. If I'm looking around at what other people are doing. I'm trying to stay in the middle lane of what's not going to make me look foolish in a committee meeting. And I'm probably not going to be on the avant-garde side of fashion. As it pertains to music, why is it true that as a song is played more frequently on the radio, it tends to be more broadly accepted and become more popular over a period of time? Again, that's that bandwagon effect. People hearing it, not necessarily it grows on them, but frankly, it's really packaged in such a way that they'll consume it and that they'll begin to appreciate it at a greater level. Look at food consumptions and diets, whether it's the bacon craze, the kale craze, the any number of different food crazes that run through periodically where you begin to see something one place and becomes broadly and then eventually goes away as we move on to something else. One of the more interesting ones, I think, is this notion of elections. And there was what I thought was a fascinating study back in 2003 where they surveyed folks that voted in elections. And what we had was somewhere between 5 and almost 20% of the population essentially saying, I always vote for the probable winner of an election. I want to be on the winning team. I don't have a particularly strong bias, and if I'm going to vote, I want to win, regardless of what the policies may be. That has a tremendous impact on how people behave, not wanting to be out of step with their peers. And that has the downside, clearly, which is that if you have participants who talk disparagingly about the retirement plan, that may impact the likeliness with which other participants elect to participate. Secondarily, if you have very vocal people talking about how bad or scary the economy is, we will see plans that have very vocal people ultimately have an impact even on asset allocation, where people are concerned with the risk of the economy. And all of a sudden, you see huge accumulations in cash as future enrollees share the same concerns that they've heard from their peers. I do think that this is one of those fixable biases. And trying to find folks that are vocal and are influencers to either bring into the committee setting so that they can be advocates sharing the benefits of the retirement plan, the process, the importance of retirement savings. If you can identify those influencers and bring them into the communication cycle, and in some cases even into the committee, they can have a tremendous impact even on plans where participants may have to elect their own enrollment rate. They'll be very big advocates for why participants need to enroll now. And for those that should be invested, accept risk, and take risk over long periods of time. The data related to how much participant behavior impacts enrollment rates and asset allocation is highly, highly compelling. While not as effective, obviously, as an auto-enrollment and auto-escalation, it's certainly far more effective than employee communication meetings and trying to drive behavior or change in behavior among your participant population. The next for our low confidence investors clearly is familiarity bias. And really, familiarity bias at its core is misinterpreting your casual knowledge of a security or type of security as somehow that reduces risk. We see it on the personal finance side all the time. I like Apple products, therefore Apple must be low risk. Or I drink Starbucks coffee, therefore Starbucks coffee is low risk. But you could probably extend that to Washington Mutual Bank back in 2008, 2009. I have a bank account at Washington Mutual Bank, therefore it is low risk. I think that's a very low level of information, but one that people tend to rely on pretty heavily because, again, we're asking them to operate in an area where they don't have high confidence, they don't have tremendous information, and frequently don't have the time or interest to develop that in a more robust way. But as it relates to low confidence investors, what we see clearly is 4 things that happen in defined contribution allocation. One is if there's company stock, they tend to allocate to it heavily. I work for the company, therefore I understand the company, therefore that's where I'm going to park my money, which has its own set of unique risks. The home country bias. I know U.S. companies, I don't know international companies, therefore my assets are predominantly going to be invested in companies that are domiciled here in the U.S. The large cap bias. So I have heard of Apple. I have not heard of the small technology name. Therefore, I'm going to buy mutual funds or stocks of large capitalized companies that I've heard of. And sector funds being the last. I think we see it all the time among tech companies, in other industries, healthcare as well, which is we are in this sector, therefore we should have an investment that specializes in this sector because we feel like we have an understanding. Despite the fact that those understandings are very, very frequently not robust, not detailed, and certainly not focused on the investment attributes of those organizations relative maybe brand or products or other things that are only tangentially related to the success of those investments from a performance perspective. So I pulled some information from the PSCA 2017 study. I didn't include every single slice of the pie because there's a lot here. But if you look at the average asset allocation of plans, what's notable? What's notable is company stock is a 3% allocation, one of the larger allocations, frankly, among all different asset classes available. That notion of familiarity. I'm familiar with my company stock, and that obviously doesn't even doesn't even account for the fact that most plans don't offer company stock. Familiarity bias certainly falls into the allocation between home country stocks and international stocks. Domestic equity makes up about 36% of the average plan. International equity only 9%, so a 4-to-1 difference when in fact, if you were to look at global capitalization, the difference between U.S. and international is probably closer to 60-40. You can take a look at the same thing on the domestic and international bond side. Domestic bonds, 8%, international bonds, barely 1%, so almost an 8-fold difference. And then sector funds, so the notion of buying these individual sectors where we feel like there's familiarity at a mere 1%, at the entire 1%, which is pretty significant given how small something like international bonds or even international equity is among retirement plan allocations. Next, I want to talk about is this notion of regret avoidance, and I think this for low confidence investors is absolutely maybe one of the primary, if not the primary concern from a behavioral finance perspective. Ultimately, the notion of I don't want to mess this up, and the regret being that I was given money by my employer or I elected to not buy things and save money myself, and that money went away. Regret avoidance is tremendously costly to investors. And what we're doing here is showing you the information surrounding the decline of the Dow Jones and S&P 500 index over the period up until March 9th of 2009. We had this tremendous decline. You can see the negative returns from January 1st to March 9th, where market indices were down as much as 55% in some cases. Clearly, from a regret avoidance perspective, all through late 2008, early 2009, we had participants divesting, selling their equities, getting out, and trying to avoid the negative market returns that were experienced over that period of time. Ultimately, we had a huge day on March the 10th. The bottom was March the 9th. The Dow Jones rose almost 6% in a single day on March 10th. And then if we look at the subsequent returns over the next period of time, ultimately missing just that single day evaporated almost a third of the total returns that were achieved by participants over the subsequent period of time. Trying to time markets is tremendously costly, and the primary reason it happens as participants are wanting to avoid risk. They're wanting to avoid the downside. That can happen. You can miss a portion of the downside, no question. What's virtually impossible to do is time perfectly the uptick. And frequently, and historically, if you look at huge market corrections, this tends to be true, the period of rapid recovery in the initial days of a market recovery are clearly not well telegraphed. And most participants end up missing all or a huge portion of the rapid recovery in the initial days of a rally. So I wish the only problems were on the low confidence side, right? We could probably fix those with default enrollment tactics, using QDIAs, re-enrolling in QDIAs as a way to try and get participants to use status quo bias as a way to try and rebalance and reallocate their portfolios. Realistically, we have similar problems on the high confidence investor side, right? Our primary objective, as I talk to committees about our high confidence investors, is trying to create some reasonable friction to avoid harm, but then also to provide adequate information so they can try and independently assess the success of their approach, which is difficult to do. So when I say add reasonable friction, how can we make it marginally more difficult for a participant who may want to do something that is highly concentrated and adds tremendous risk? Well, in the notion of a brokerage window, it's trying to get participants to sign disclosures or acknowledge that they're doing something that is out of the norm and may have an impact, and that their approach is something that's not being monitored by the committee. And as it pertains to how do we get information back to those participants, for those that are doing things that are tremendously unique within their investment approach, how do we help them better understand how they're doing relative their peer group? Because we can use that same the same biases of how peers are doing to try and drive people back to more normalized investment outcomes, which in many cases may be better than the higher risk, higher confidence approach that they're taking independently. So on those high confidence investors, not surprisingly, high confidence moves to overconfidence relatively quickly. There's a great study from back in 2002 that took a look at these high confidence investors and overconfident investors. And what they did was ask those investors what they projected the return of the market to be over the next 12 months. So you can see a data set in 98, a data set in 2000, another data set in 2001. And they said, well, I think the market's going to do 13.4, 15.2, 6.3%. Then they said, well, how well will you do over the same 12-month period? And these investors ultimately projected that their return, net of fees, would be over a full 1.5% higher than the return of the market over the exact same period of time. So not only were they going to have to overcome the impact of any cost that they may have paid for funds or advice that they were receiving, but secondarily, that their allocations and investment decisions were going to have to be a full percent on a 12-month basis, a full 1.5% higher than that of the market. Not surprisingly, the secondary piece of this is that overconfidence hurt them in two ways. A, the return of the market didn't end up being as high as they expected it to be. And two, their return actually ended up being less than the return of the market. This notion that even without regard to data, you continue to be confident in your ability to do something that statistically is tremendously difficult to do on a continual basis is one that can only be met with additional information to try and test their confidence in hindsight. The challenge is in hindsight, we fall into the hindsight bias, which they look back and say, well, I should have seen that this was going to happen, and therefore I won't repeat that same mistake again. So if you look at what happens in a marketplace, we look back to 08, 09 and the growth in the use of mortgage derivatives and the increase in real estate prices. And it's certainly easy to go back in hindsight and say, well, I understand why this happened and why we had a banking crisis and why that led to a market crisis. So I won't let that happen again. The problem is these things don't happen in the same way over and over again. So that hindsight bias causes these overconfident investors to feel even more confident going forward, that they've learned the lesson that they won't repeat. The challenge is that there's a brand new lesson awaiting them around the corner. So that hindsight is 2020, but it doesn't unfortunately extrapolate to what's going to happen on a go-forward basis in returns. So these overconfident investors certainly struggle with familiarity bias in a different way than their underconfident peers. On the company stock side, what we see is really two things that weigh into it. Tremendous allocation to company stock when it's available. So here's some data looking at plans of different sizes that have company stock as an investment option. You know, you're looking at average holdings in the 15, 16% neighborhood, depending on plan size. That's a huge allocation if you go back to my previous pie chart relative to a plan that may not have employer stock. But part of the problem with overconfident investors and familiarity bias is investors who overweigh the probability of realizing extreme gains through equity exposure, try and accomplish that by holding fewer and fewer stocks. and their expectation is I'm better at picking stocks than the marketplace as a whole, therefore I'm going to achieve a better outcome. There's absolutely no evidence that would support that that is an accurate way to look at it. Holding fewer stocks creates greater volatility, but doesn't change the expected return. So this familiarity bias can really be devastating to these overconfident investors. And clearly, as you look at the number of stock drop cases that have been out there, and frankly, even a few plans where the companies have gone into bankruptcy and the value's been lost entirely, the impact of that 16% of your portfolio going to zero or being chopped in half from a performance perspective is absolutely devastating on the accumulation and returns period for that set of the investor population. And really falls into this notion for overconfident investors of making something that is highly complex simple. And extrapolation is the notion. If you look back at those overconfident investors projecting what the returns were going to be over the subsequent 12-month period, what we found is there was a tremendously high correlation between what had happened over the last 12 months and what they thought was going to happen over the next 12 months. And what is the most difficult thing to communicate to investors, be they low confidence or high confident investors, is the notion that the market price today incorporates all the known information and all the various investment parties. What will impact what's going to happen in the future is those things that are not known, or things that we thought were unlikely occurred, or we thought were more likely and did not occur. So looking backward to try and generate forward return estimates is a comfortable or familiar way to try and extrapolate returns, but unfortunately has no accuracy or reliability in generating outcomes. And then the last, but not least, is this notion of neglecting probability or the gambler's fallacy, right? The gambler's fallacy being, I've been at the roulette table, I've lost 27 times in a row, I'm due to win. I'm at the blackjack table, I've busted out 15 times, I'm due to win. Not understanding that, similar to extrapolation, what's happened in the past has no impact on the next event, right? If you have busted roulette 27 times in a row, you are just as likely to bust the 28th time. The fact that you had a bad streak doesn't impact the next period of time. And ultimately, we see that on two sides. One is I've done really, really poorly, therefore I'm due to do well. But more frequently what we see is this notion of looking and saying, I'm trying to avoid the one catastrophic market event. And by avoiding the one catastrophic market event, preserving my capital, I'm missing out on years and months of progressive returns that would help me accumulate a larger retirement outcome. So traditionally, we continue to see this in areas where investors are buying high and selling low. They are buying securities that have done well over the last 12 months, selling securities that have done poorly. And that is having a tremendous impact on that Dalbar study, how participants are doing, and the impact of how participants are doing on their ability to secure an adequate and reasonable retirement. The extreme examples of this really come into these times where we have these market shocks, these things that markets had not anticipated, and how participants tend to react, and really how markets react. So, we've listed here, 8, 9 different pretty tremendous periods of volatility of the markets. Anything from the Japan attack on Pearl Harbor to the destruction of the World Trade Center over a 60-year period of time. And not surprisingly, in the overwhelming majority of those cases, the market had a very significant negative initial reaction. So the World Trade Center was destroyed in 2001. Markets were off 7%. But ultimately, it doesn't take markets long to factor the new information, rebalance markets, and readjust returns. If you look at the subsequent month, 6 months, 1 year, these tremendous market corrections that everybody thought at the time were tremendous shifts in the dynamic of how the economy operated or the country may operate, ultimately ended up being pretty low impact on investments and markets. Participants don't see this at the time, though. They see these events because of the magnitude that they are, and tend to extrapolate future negative outcomes that cause them to, again, retract, try and preserve capital at the expense of generating adequate investment returns. One of the more interesting studies, although not terribly surprising, but I hadn't seen it measured before, was one that we picked up from TIAA about a month ago, looking at behavioral factors and long-term well-being. And not surprisingly, when they looked at participants, what they found is the less behavioral finance quirks they were subject to, the higher their financial well-being. So the more of those peculiarities that dictated their behavior, the more likely they were to be less prepared and less successful financially. The less of those behavioral finance traps that they fell into, the higher the financial well-being. The challenge here is I don't ultimately think that you can educate people out of these behavioral finance traps. I think they're programmed relatively easily. Some of them may moderate from time to time. I think the trick for a very progressive defined contribution plan is how can you take those behavioral finance traps out of the equation? How can you remove them in such a way where the plan's successful despite the fact that we know that the participants aren't perfect calculators who are always going to act rationally and make the right decision? Some of these things actually, from a behavioral finance perspective, also impact your committees. I wanted to point out two of them that we see time and time and time again, that if not managed effectively, will actually flow down and impact participants. And the first is this notion of post-purchase rationalization. So as a committee, if we buy something and it doesn't turn out the way we had hoped, that could be a vendor, could be a service, could be an investment product. We spend a lot of time trying to convince ourselves it was the right decision. It's very difficult, especially for committees, and typically the committees we work with are committees of very, very successful individuals within their organization, with leadership roles. It's very difficult to acknowledge when they've made a bad decision. We picked the wrong vendor, we picked the wrong investment product. How do we ultimately acknowledge those mistakes quickly and adjust our course of action in such a way where we can repair that? I think we see it on the bad investment product side, where we bought a product 6 years ago, that product is underperformed. We continue to stick with that process, despite the fact that there's a tremendous amount of evidence indicating that perhaps the premise upon which it was purchased was inaccurate. The notion of resistance to adjusting strategies going forward could be vendors. We picked XYZ record keeper. It was expensive and time consuming to move from that record keeper to the next. How do we acknowledge the fact that we're not getting what we need at the right price and make an adjustment? And then hesitance to review vendor buying decisions. So this post-rationalization shows up here, certainly shows up in status quo bias when you walk into plans where you can very clearly tell the vintage of the investment menu, right? We can walk into a plan and say, well, this investment menu was created probably in 2002 based on the products that they're still utilizing. On the investment product side, and it's hard to convince committees of this because I think there's so much money that's been extracted or expended by financial services firms. Investment products are by and large commodities. So we're trying to find the best outcome at the lowest possible price. Getting too attracted to the brand or the name both hurts committees, but can also hurt participants as they make decisions about their own investment allocations. The second one we see on the committee side is this negativity bias. It's really difficult, given what we see in the media today, not to be particularly concerned or negative about the prospects of the economy going forward. But it's also important to point out that information is being packaged in such a way to try and generate readership, eyeballs, and clicks. And ultimately, the way to do that is to present as much bad news. Bad news gets a lot more clicks than good news. So understanding that the negativity bias is one that we're subject to, committees have to resist the urge to retract, right? Bring themselves in, or encourage participants to bring themselves in and not become fully invested and full participants in the retirement savings process. So as it relates to trying to fix the investment menu structure side, there's a few things that we would point out. I think tiering investment menus is tremendously impactful in reforming and reshaping how we communicate benefits. It clearly simplifies decision making. We're trying to make employee communication easier, making decision making easier both for our low confidence and our high confidence participants. We do want to create meaningful choice, right? And the overwhelming majority of defined contribution plans are participant directed. To that end, we want to acknowledge that participants are different ages, different interests, different risk tolerances. We need to give them the right set of tools to develop their own portfolios and solutions, and acknowledge that they have different wants and needs in putting together their portfolios. However, in doing that, I think it's important that through the communication process and trying to wire this as much with your providers who communicate these investments to participants as possible, getting rid of extraneous and redundant investment options. When we create a large number of investments that do largely similar things, that unnecessarily complicates to no financial end the investment menu. So it may prohibit participants from feeling confident. It may cause them to have confidence in diversification that actually doesn't exist. Second, the notion of kind of concretizing, framing consequences for decisions that participants make. In some cases, for a high confidence investor, that may mean acknowledging that they're taking additional risks by moving into a self-directed brokerage account or by allocating a huge percentage to employer securities. For a participant who elects to reduce their savings rate, the impact that that'll have on the amount of income they're going to have in retirement. Taking these notions that are esoteric and trying to create realistic consequences so participants can better understand the consequence and therefore potentially adjust their behavior. Categorization, and the whole notion of tiering an investment menu is the idea of trying to categorize investment products in such a way where participants can identify the types of investment products more easily, right? In a defined contribution setting, it's entirely common to have a list of 28 different investment options, and participants put the percentages they want in each. It's really difficult to try and get participants to do that in a way that's rational if we haven't helped them bundle and categorize the products and understand what types of participants might elect to use what types of products. And then last but not least is condition for complexity. Start simple, create the ability and avenues for participants who do have either higher confidence or higher competence, the ability to go further and further, but gradually go further and further. Rather than throwing all of our participants in the deep end of the pool, how do we train them, let them play around in the shallow end, and only once they develop skills and confidence do they begin to move to more complicated elements. So in looking at tiering, traditionally we're looking at relatively simple tiering scenarios where we say, hey, at the start is these asset allocation products where we take our low confidence investors, and frankly, in some cases, maybe our high confidence investors who have low amounts of time, and give them low cost asset allocation models that are reasonable based on their age and risk tolerance. Gradually, as we move into that pool analogy to a slightly deeper part of the pool, perhaps we're using some core products that are passive in nature. We're not trying to outperform the market. We're not trying to outsmart the market. We're trying to achieve market returns consistent with that Dalbar study. For participants who have a higher level of confidence and more time, perhaps there we're moving into smaller asset allocations where they can pick selectively active products to augment or try and outperform markets. And then for those that have very specific needs, and only after they've gone through some of that gateway processing, would there be a self-directed brokerage or mutual fund window or some other avenue where they could exercise or purchase investment products that may not be appropriate for the population at large. Third really gets into the notion of lifetime income, and it's one that I think is going to become more and more talked about over the course of the next decade. We spent so much time on the accumulation phase, and I think retirement plans through automatic enrollment, auto escalation, default enrollment elections, and investment allocations have come up with better and better outcomes. The challenge at this point, and especially with the death of the fiduciary rule, continues to be us releasing participants into the marketplace that have large sums of money, but no easy path to convert those accumulations into retirement income. And here we struggle really from two different biases that participants have. One is the current moment, right? It's difficult for participants to imagine themselves in the future. And here I'm talking about a retiree. It's difficult for a 65-year-old who may be retiring to imagine themselves at 85. What is their cognitive capability? What's their interest level? How much time? What's their health circumstance? Very, very difficult to do that. Typically, when a participant retires, their cognitive state is very good. Their health is hopefully very good. They're planning on doing some of the things they didn't have an opportunity to do. But that certainly has an impact on how much they may be willing to try and hedge the longevity risk of living a long time. And second is the illusion of control, right? The notion to people to overestimate their ability to control events in the future. It's the same as the overconfidence bias on the investment side to some degree. That you have no control over what will happen to markets after you retire. But pretending that you might is going to have an impact on whether you choose to hedge or purchase some form of lifetime income or maintain it all in a liquid investment pool. And the last, and I think this is true of everybody from 4-year-olds to retirees, is people tend to prefer immediate payouts over delayed payouts, right? So despite the fact that the delayed payout may be, frankly, much higher. So I look at the marshmallow test where you say, hey, here, 4-year-old, here's a marshmallow. I'm going to leave for a few minutes. When I come back, if you haven't eaten the first marshmallow, I'll give you 2 marshmallows. Well, a lot of kids pop the first marshmallow in the mouth the second the researcher walks out of the room. And I think we get that on the investment side too, right? The notion that the big pot of money is better than a lot of smaller chunks of money over an extended period of time. I do think that even on the lifetime income side, although it's harder, I think there are ways to try and frame those decisions as well. I think creating greater flexibility on the lifetime income side is important. Things like bonus annuities and limited penalty-free withdrawals, partial annuitization. The notion of somebody taking $1 million and converting it to one lifetime annuity, I think, is not very common. But trying to find some of these hedges to reduce risk and longevity risk, the notion of outliving your income is important. Framing becomes critical, right? Downplaying investment attributes and educating participants on the impact of inflation over someone's life expectancy is very, very important. And I think it's important to acknowledge that there are external factors, right? As it relates to annuitization, or certainly the rebranding in the defined contribution space and calling it lifetime income, is that participants have a high negative bias towards annuities. And annuities have earned it. So that is annuities and insurance sales organizations have earned that negativity bias. So trying to create up with new ways to frame that information. And the second is a probability bias, the notion that participants fail to acknowledge the likelihood of them living a long time, or the probability of them achieving a return that's greater than the return that they would actually need. On the pre-retiree need side, we're getting to the fourth and final piece, which is good because we're running short on time. But the pre-retiree need side is helping educate participants on when they can retire and how much do they need to have. And I think far too many retirement plans focus their education resources on the wrong population. It's really easy to get a 25-year-old in a plan, allocated adequately, and to ignore their retirement savings for the next 2 decades. And that's probably a really good place for them to be. Most of the education difficulty, in my experience, is trying to talk to the pre-retiree population, folks that are beginning to have to make decisions about when, how to receive benefit, how long to work, and what to do with their healthcare circumstance and their retirement accumulations as they near that date. It's really critical to bring those retirement plan projections to a fine point. It's great to have a website or a statement that projects income. That almost always fails to include external assets, spousal assets, their actual spending needs, their healthcare costs. How do we provide resources to that particular population? And then how ultimately can we provide advice on how to secure or protect accumulated savings? With the death of the fiduciary rule, again, we have lots of people providing sales resources in this area, but how do we get participants objective advice to help them make good decisions in transitioning from accumulation to income flows? And I would argue that it's really important to get this piece right. If you look at the research that's out there, if we are not helping educate our pre-retiree population on when they can retire successfully and safely, they will likely not retire. And the data is very, very consistent on this point. And realistically, if they don't retire on time, that has an economic impact. And the economic impact can be material. Could be workers' compensation claims, could be disability claims, and clearly healthcare costs. All three of those areas show up as massive increases for our aging population. And if our aging population is engaged and productive and serving the organization, then clearly that's a good thing that we're able to keep them. If they're working merely because they're not sure if they can retire successfully, that's an entirely different consequence. So, last but not least, I'll talk about this notion of inverting your retirement plan, which is where I think defined contribution plans will grow over the course of the next decade. We started with defined benefit plans where all of the responsibility, contribution rates, asset allocation, forms of benefit, retirement eligibility, all those decisions were made by the employer. And I think we moved to the other extreme. Defined contribution plan, you put your money in, you determine the asset allocation, you determine how long you're going to work, and you determine how you're going to take the benefit. How do we migrate the best aspects of the pension environment and bring them into the defined contribution arrangement? I mean, how do we look at retirement adequacy instead of looking just at our contribution rate? How do we look at participant performance instead of just looking at the performance of the investments themselves? And how do we help our least sophisticated participants overcome some of those behavioral finance capabilities that are out there? And the good news is I think that process doesn't change a lot. It's the same process that we've talked about for the last decade, but moves us into this measuring plan effectiveness. How do we remove our obstacles to participation? I think we're getting better at that as an industry level. How do we improve deferral rates and participant behavior? I think we're getting better at that, and I think there are more things we can do as it pertains to white labeling investments, tiering investment menus, streamlining investment menus. How do we plug holes? How do we prevent participants or reduce the possibility that participants will take distributions before they're ready? And then how do we educate participants about where they are in accumulating enough for an adequate retirement? And then measuring that effectiveness. This really is the next step, right? Once we get to plans that are not broken and that are fiduciarily prudent, how do we have plans that are even more effective than what we may have come up with to this point? So I really want to thank everyone for attending today. I knew I had an ambitious set of slides, so I apologize if I was talking quickly. As I mentioned, we recorded it, so you can try and re-listen to it at a slowed down pace at a future time. But I'll start taking questions now, so if you have any, I'd be happy to take them. But if not, again, keep in mind we'll be sending out copies of these slides, as well as a link to the recorded presentation in the next several days. I want to thank everyone for attending again. I know it's hard to get an hour of time dedicated. Hope you got some value out of today's presentation. If you do have questions that may come up after thinking about it, please feel free to reach out. I'm always happy to have a quick dialogue, answer, clarify any of my previous comments. And again, thanks for participating. Look forward to your attendance at a future presentation. Thanks and have a great day.